What if you could retire early without a sky-high salary or a lottery win? You can do it with a simple, steady plan using index funds. Today, I want to break down a straightforward path to early retirement that doesn't require wizard equations or hype. It's a plan you can start this week even if you've never touched a stock before. First, I'll lay out the core idea. The market is unpredictable, but over decades, broad index funds tend to rise. By buying the whole market, you own a piece of thousands of companies and let the long-term trend do the work. Let's start with a habit you can build today. Decide what you want to quit doing financially. Do you want to cut a big monthly expense, earn a side income, or both? The goal is a higher saving rate because the faster you save, the faster your money can grow. Step 1 is to define a target retirement number. A simple rule of thumb is to multiply your annual expenses by 25. If you expect to spend $40,000 a year in retirement, you're aiming for around $1 million. That number guides everything else, so write it down and revisit it every year. It should be realistic, not magical, and it should keep you honest about how much you need to accumulate. Next, design your savings plan. The main lever isn't your picks of funds, but how much of your income you set aside. A 50% savings rate sounds crazy to some, but it's not a mystery. Trim expenses where you can, and channel the rest into investments. If you can't save 50% yet, start where you can and increase the rate gradually. The key is consistency. Small, regular contributions compound into real wealth over time. Now the investment part. You don't need a complicated portfolio to retire early. A simple two-fund setup works well for most people. A broad U.S. stock index fund and a broad international index fund. Choose low-cost options. Fees matter a lot when you're building wealth slowly. A fund with a 0.05% expense ratio costs you far less over 30 years than a fund at 0.50%. Keep it simple. One fund that tracks the entire U.S. market and one fund that covers developed international markets. If you're in a country with a strong stock market, you can use a similar global approach with local funds. Set an asset allocation you can live with. A common starting point is 80% in stocks and 20% in bonds, or 60-40 if you're younger and want a bit more safety. Your exact mix depends on your stomach for risk and how soon you want to retire. Make a plan for rebalancing. Markets drift, and your allocation will drift too. Do a light rebalance once a year, or automatically adjust back toward your target mix if your platform supports it. Automation is your friend. Set up automatic monthly contributions to your investment accounts and automatic transfers from your checking to your investment accounts. You want money going in without you having to think about it. Tax efficiency matters too. Use tax-advantaged accounts when you have them and keep taxable accounts for the rest. In countries with tax-advantaged retirement accounts, prioritize savings there, then fill taxable accounts once you've hit the annual limits. Don't ignore an emergency fund. A small cushion, 3 to 6 months of expenses, keeps you from selling investments at a bad time. It sounds boring, but it protects your long-term plan. Debt matters as well. If you have high-interest debt, your first priority is paying it down. The return on paying off debt is often higher than any market return, especially in the early years. Now, a practical example to illustrate the math. Suppose your annual expenses are $40,000 and you save 50% of your income. You'd be investing roughly $20,000 a year. If your investments earn about 7% after inflation over the long run, your portfolio could reach around $1 million in roughly 25 years. At that point, with a 4% withdrawal rule, you'd have about $40,000 a year to live on, which matches your goal. Of course, markets aren't predictable, and you might retire earlier or later. The point is the principle. Time and consistency compound wealth, while fees and mistakes erode it. Let's talk about the risk you actually face when you retire early. The main risk is sequence of returns. If you hit a bad market right after you retire, you could run out of money faster than you expect. The cure is a conservative withdrawal plan and a buffer in your portfolio. A simple way to stay safe is to keep more bonds or cash near the front end of retirement. You don't need to go all in on stocks forever. As you age, you can gradually shift toward a more conservative mix. Another common trap is chasing hot funds or trying to time the market. Index funds aren't exciting, but they're boring in the right way. They give you broad exposure with low fees and less risk of a dramatic mistake. Don't ignore taxes. A tax-efficient plan can add years to your retirement horizon. For many people, tax-advantaged accounts should be the backbone of the strategy, with taxable accounts filling any remaining space. Now, let's discuss a few habits that keep this plan on track. Track your spending without judgment. Just log what you spend and look for recurring patterns you can trim. The goal isn't perfection, it's awareness. Build a simple weekly ritual around your money. Spend 15 minutes each week reviewing contributions, balances, and any news about fees. Small routines beat big resolutions that never happen. Document your plan in plain language. Write down your target retirement number, your current savings, and your annual contribution. Update it at least once a year or whenever your situation changes significantly. Learn a few basic math tricks that help you stay on track. Compound growth is the real star, so understand how time affects your money. The sooner you start, the easier the ride. Keep a long-term perspective. Short bursts of fear or greed can derail a steady plan. The market will rise, fall, and rise again. Your job is to stay the course. Now, a few practical checkpoints you can use as you move forward. Checkpoint 1, is your savings rate high enough to reach your target in your preferred time frame? If not, where can you cut or earn more? Checkpoint 2, are you properly diversified? Are both index funds represented and the balance aligned with your risk tolerance? If you can answer yes to these, you're mostly there. Checkpoint 3, are you minimizing fees? Are you using the lowest cost share classes and avoiding anti-mimic products? If you're not sure, ask yourself if a cheaper option could do the job. A quick thought experiment. If you start at 25 with zero savings and manage to save 40% of your income each year, you won't reach $1 million in 20 years in a tight market. You'll likely reach that target a bit later, but you'll still be on track if you stay consistent. The key is not perfection, but persistence. What about real life? I've seen people reach early retirement not by miracles, but by showing up every day. They automate, they live below their means, and they keep investing in boring things that work. Here are some non-flashy but true principles to steal from their playbook. First, embrace boring consistency. The plan is not flashy. It's reliable and repeatable. Second, protect the habit even when life gets loud. Job changes, moves, or big expenses. Let me address a frequent objection. I can't retire early because I love my job or I want options. Early retirement doesn't mean never working again. It means financial freedom enough to choose how you spend your time. If you want flexibility, you can build multiple streams while you invest. A side gig or passive income from a small business can accelerate your timeline, but make sure it doesn't complicate your core plan. The index fund path remains the backbone. A quieter but powerful shift happens in your psychology. You start rethinking money as a skill you improve, not a treasure you steal. Each month, you turn a portion of your income into ownership of the future. Now, a note on hosting your plan online. You don't need to post about every win, but it helps to share your progress. Being transparent with a small audience can keep you accountable and bring practical ideas from outside your own circle. What about volatility days? If the market drops 20% or more, what should you do? Stay calm, stick to your plan, and avoid panicked selling. Rebalancing and continuing contributions during downturns actually buys you more future growth. Let's talk about a few mistakes to avoid. Don't overtune your portfolio chasing the best performing fund of the year. Don't try to time every dip and spike. And don't neglect the boring work of tracking your plan. Also, don't forget to set your expectations. Early retirement is not a magic moment when all problems vanish. It's a change in how you spend your days and how you think about money. A practical ritual you can start this week. Pick your target retirement number, pick 2 index funds, and set up automatic contributions. Decide your savings rate and commit to reviewing the plan every year. That's enough to begin. If you're unsure where to start, a simple framework can help. Open an account, choose one broad U.S. index fund and one international fund, set your allocation, and enable auto-contribution. Then add a bond sleeve as you get closer to the horizon. As a final reminder, this plan doesn't require knowing everything at once. It requires sticking to a few simple rules consistently over many years. The biggest single advantage you have is time and starting soon. Now, a quick recap so you can implement without rewatching this whole thing. Decide on your target retirement number. Build a high savings rate even if it takes years to reach it. Invest in a simple, low-cost index fund portfolio and automate your purchases and rebalancing. Protect the downside with a modest bond allocation and a small emergency fund. And keep revisiting your plan with a clear, calm mind. If you're listening this far, you likely want a practical starting point this month. Start by naming your target expenses, calculating your 25x rule number, and setting a real monthly contribution. Then pick 2 broad index funds, set a reasonable asset mix, and turn on automatic deposits. Finally, the quiet truth I want you to walk away with. Wealth isn't a secret formula. It's a sequence of small, correct choices repeated for a long time. Index funds do the heavy lifting, but your daily decisions control the pace and the path. If you found this helpful, like this video and subscribe for more practical money clarity. Share in the comments what your plan looks like, what hurdle you're facing, or what part of the road you're most curious about. Your story might help someone else start today.